I'm Megan Roberts, agricultural economist at Compeer Financial, and I am excited about today's episode where we are going to talk planting, grain marketing, and risk management strategies. I'm joined by Jeff Kazin and Mike Rolfson, co-owners of Agris Academy, along with Mark Cook, financial officer at Compeer Financial out of the Wade Park office. Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business. Why don't we just do a quick round of hellos? Jeff, I'll hand it off to you first.
Yes. Hello, Jeff Kazin. I did a 30-year career in the commercial side, working for Cargill all over the world, trading, and I also farm. So when I decided to look for something else and want to go farm more, we decided to get into a business that is solely focused on education, and that becomes Agris Academy.
Mike?
Yeah, Mike Wolfson here. I spent 20 years in Cargill, not quite as long as Jeff did, doing much of the same things together along the way. Broke off in 2009 and spent a fair amount of time in early stage ag tech and venture capital investment. I don't farm, but I farm vicariously through Jeff and a lot of our customers. And I do own 2 small farms in between Northfield and Faribault, Minnesota.
Okay. And Mark.
Yeah, I'm Mark Cook. I'm a financial officer with Compeer Financial. I'm in the Wade Park office, and I've been with Compeer for 17 years and happy to be joining you today.
Well, I think this is such a great time of year to be talking about this topic of grain marketing and risk management, because spring planting, certainly as a farmer myself, is one of the most operationally intense times of the year. You've got markets moving. There has been a lot of non-agricultural events that are affecting agricultural markets right now. There's weather markets, margins are shifting, and I would argue that there is some increased risk exposure that is going on right now. So while today's conversation is not about forecasting prices, it is about the structure of grain marketing. And I know that we really want to get into, from Jeff and Mike's perspective, kind of 5 foundational disciplines that they see helping to shape how risk is managed during this growing season. So Jeff and Mike, you've really built a framework around 5 best practices. I want, before we get into those, to set the stage for us a little bit. Why start with grain marketing and risk management fundamentals right during planting season?
You can't really actually just start in planting season. Let's be clear. It's just the reality that is the commitment of farming starts way before planting, but there is a finality as you start to drop seeds, right? You're committed to growing that crop, and it does, as you say, extend up that level of intensity. And in planting, I think one of the things that can happen is it becomes all consuming, and you can really take your eye off of risk management. It's almost by the nature of the business, right? We run at more than max capacity for a period of time as grain farmers anyway. So yeah, it just becomes all that more relevant. It becomes all that more real, even psychologically, as you start to go in and plant that crop. And there's a whole bunch of things you can do well before you ever drop that first seed that puts you in a really good position and a really good mindset to manage the risk of the farm.
Yeah, absolutely. So, Mike, when you look at planting this season specifically, where do you see producers maybe most exposed from a risk management standpoint as they're dropping, as Jeff just mentioned, those seeds in the ground? What are you thinking about, Mike?
We'll touch upon it here later in the podcast, but just as a super quick highlight, I think going into this time of year, and Jeff alluded to it, we teach that a good merchandising and risk management plan starts the year prior. Year defined by sort of harvest to harvest. So when you're harvesting in the fall and the dust settles there, you should already start to at least put some back of the napkin thoughts together as to what next year looks like and start to consider that implicitly in your risk position. So we'll talk a little bit about that later, so I don't want to beat that one up. But the other thing that we start to go down the road on, especially this time of year, is sort of separating your farming business from your elevator business and the merchandising side after you've harvested. Sort of strategically, this time of year, risk is best managed by thinking largely around the hedging aspect. However way you're comfortable in hedging. You can do standard hedging, hedge to arrive, some of the more complicated marketing alternatives that are out there. So this time of year, if you look at big picture risk and ways to start to think about mitigation of some of that as these opportunities arise, it really rests primarily in the hedging piece and sort of setting the flag on price on the board at numbers that start to suit your operation. Every operation is a little different and everybody knows what their numbers are, but this is the time of year where you should be thinking more about that when it comes to the bulk of your focus on the risk management piece.
Yeah, I totally agree, Mike and Jeff, with both of your answers here. And I really appreciate your commentary about it starting before spring planting, because as an ag economist, I think about that all the time, just the whole year long marketing plan, and that when you are harvesting your last crop, you are starting with your next crop in that moment. And you're already making, if you're doing good risk management, you're already making decisions for spring. And particularly this planting season, I've had so many questions really about the uncertainty of inputs during March and geopolitical uncertainty. And I oftentimes had to give the answer of, well, most of these decisions have already been made. It is unfortunate that we have a little volatility, extra volatility during planting, but from a risk management strategy, a lot of things already happened in fall of 2025. But now I'm going to hand it over to Mark, and I'm curious from your perspective as a financial officer, how does planting season change the conversations that you're having with clients? And maybe you can comment a little bit on this conversation we've just had about when do you see the risk management strategies coming into play for the planting season? Is it at planting, or are you really talking with clients about this all the way back the harvest prior?
So it's a great conversation point, and a lot of my clients, my guess is they start getting pretty annoyed with me for talking about having a pre-planting plan and the opportunities that traditional spring volatility provides. And it's a matter of, number one, understanding your cost, carrying crop insurance, having a plan, and executing that plan. Oftentimes in the spring planting season, producers are sometimes too focused on old crop and maybe some of the regrets or decisions that have already been made. And I always say the cows are out of the barn. Like, let's forget about old crop for now and let's focus on new crop, because again, many times, not every time, but many times, some of the spring volatility will provide opportunity for old crop. So I always try to decouple. It's hard for producers at times to stop when they've got a lot of product to move, to start thinking about what's not even in the ground yet. And I always just really encourage them to focus on putting a plan together for new crop, maybe even putting in some orders, decoupling basis and futures, working with professionals to make sure that they're taking advantage of some of those opportunities. And oftentimes when they're at their busiest, that's when the markets move the most, and some of those orders fill in their sleep, and based off of projections are some of the highest margin sales they might make all season. Now, that's not every year, but spring volatility, in my experience, has been a nice time to, number one, put a plan together for new crop. Number two, get some orders in the system. And number three, start putting a plan together to how can I spread my income and spread my workload out throughout the year and take advantage of opportunities as they come forward.
So maybe that's a great place to pause and start in with these foundational best practices, because I think, Mark, you've really led us into that conversation about then how do you go about with making that plan and what is the foundation of that plan. So Jeff and Mike, you start with this concept of hyper-efficient futures markets. I am a former academic, and even I think that sounds a little academic-y. So what does that actually mean in practical terms? How do you define that terminology?
Let me use this as an example for the audience here. I worked in a major commercial that all of you are well aware of. That commercial spends tens of millions of dollars on this, let's call it the monetization of intellectual property, trading for speculation. They also spend significant money on managing risk around running assets. In my experience, as the markets have matured, computing technology has matured, money flows have changed, it became extremely hard to make money consistently trading pure futures, even as a commercial, with all that information, with all that data, hundreds of people working with you. Mike was like, we had 2 phenomenal weather meteorologists on staff, right? Obviously, there's a lot of money involved if you can get this right. And it has become extremely difficult to make, even for those with lots of what we maybe call asymmetrical information, to make money consistently trading futures. And what we try to get, and we say this to farms that we meet, the hardest thing we'll tell you, you need to become the risk manager from the farm instead of a speculator at the farm. If you want to change your paradigm, if you want to relax and make better decisions, right, and have more confidence, you become the risk manager, because these markets are too efficient. You will not beat them. There is no advisor out there that will consistently beat them. We can guarantee it. We'll bet any amount of money you want. It's gotten to be extremely hard. And then once you make that jump, as I'm just going to risk manage, I can't control in our commodity markets for the farmers that are raising commodity type products, can't control the price. I risk manage those futures off. That's a piece of the puzzle. And then there are a whole series of merchandising things the local merchants do. That's a skill to be learned. And so we start to divide that up. But these markets, the commercials are actually very small participants today in, say, the CME futures relative to the total volume. So farm makes that big jump. I'm just going to become the risk manager of the farm. That's a huge jump. And then what you'll notice if you look around as a farm, all these companies that they sell grain to, they have risk managers, right? That's what they do. And that's how they are there for the long term. I know your farm clients are there for the long term. And that's that first big jump. Efficient markets, become the risk manager of the farm, and it just changes your perspective and it helps you make better decisions.
So let's maybe focus it over on the client side. Mark, from your perspective, do you ever have this conversation where there's that misunderstanding of futures markets in financial conversations related to grain marketing, and maybe folks trying to hit all the highs, which just really isn't possible in a truly efficient economic market?
It happens all the time. And from my perspective, not fully understanding the markets and specifically the tools within the market shows up in a few ways. So in my opinion, the number one way it shows up is not taking action when there's opportunity.
Because it will go a dime higher, right?
That's exactly right. Or within that is not having a process set up to take action. So it might not be that they're bullish that it's going to go higher, but they don't have a process set up for placing orders for some of those things, trades being made, sales being made with whoever they're selling to. So understanding the tools that are available within the market can help implement your plan. And then that creates missed opportunities. And then it flows into regret or doubling down on some of those missed opportunities. And then here we are in new crop again, and we're still thinking about old crop. So I think ripping the Band-Aid off and starting fresh, and let's laser focus on the fresh new crop and what those opportunities will bring. And then specifically, what tools does the market provide me to market this crop efficiently throughout the season?
Yeah, absolutely. Mike?
We have a sort of intangible around this topic late in our class where we basically synthesize all the meaty trader sayings that we heard over our, almost 50 collective years between Jeff and I doing this. And one of them is, if you're not selling into strength, when are you selling? So yeah, especially to your point, Mark, if a producer has basically nothing hedged at this time of the year, there has to be a point, say, for example, in this recent strength we've seen where they're, for a small but meaningful percent of your crop, start to think about that. Get those moments while they're in front of you.
So one of those ways that you can take advantage of those moments is when you really know your position, so you know what you're going to be marketing. Your second piece of framework is just that. Know your position so that you can then take advantage of when there are some strengths. So during planting, when uncertainty is so high, What specifically should producers have clarity on during planting, and how should they be going about figuring out exactly where they are in terms of their position?
Knowing your position is one of those things. I think, Mark, you touched upon a tendency or maybe almost like a psychology that often plagues marketing decisions. When you have those numbers in front of you, and we go back to a prior bit of work we did with you, knowing your position is fundamental. We lived it every day. Not knowing your position was a terminatable offense in our prior lives. So we bring that rigor here. Part of that is to obviously best you can know your mix of crops. And then by far the most important piece is to be as specific as humanly possible with your yields. And do not be conservative. A farmer tendency here, especially this time of year, is to be a little bit conservative. You can always change it. It's spring. Things will happen along the way. There's best practice in changing that. But this time of year, don't be conservative. You folks are getting really good at what you do. Don't use APH. That's starting to quickly becomes obsolete with all the new technology and the amazing ability for the U.S. farmer to produce at scale now. And yeah, start with that. And when you have those numbers in front of you, it also helps your psychology. You're not guessing as to what that is. And it creates much more actionable information that allows you to think clearer. And there's one part of your brain that doesn't have to think about what I actually have. It's numeric. It's sitting in front of you. And it allows you to think better about the go forward, as opposed to two layers of not knowing where you are, not knowing your position, and then, of course, trying to tame this unwieldy beast that is CME futures and your hedging reality.
Yeah, I think just to finish up around Mike. So before you start to plant, right, Mike and I have developed a program that is a risk-based look at farm positions. It's very easy to use. We offer them to all your clients. They can get in touch with us through at the end of the podcast. And it gives you a way to understand your long is obviously what you're going to grow, or if you're looking at last year, what's in your bins. And your short is where you're managing that risk down. That's your various hedging opportunities, sales, and all other alternatives. And before you head off to the planter, if you have that and you know where you are, knowing that position, again, that allows you to make quick decisions, right? Even though you don't have a lot of time, but if there are opportunities, because you know where you are, right? And it's a key. So futures is a risk to be managed, and it's generally a psychological challenge, right, to manage risk. And then the merchandising side, the physical, are skills that Mike and I teach, right, as part of that. So what we're really talking about, knowing your position, is that having those clear numbers puts you in a better psychological place to make good decisions. Know what your position is. We have yet to be on a farm, and I would say we have connected over the last 3 years. We're somewhere close to 500-600 different farm entities at this point. We have yet to find one that knew their position when we started working with them. It's not something that's taught, and what Mike and I have done is we've brought the commercial rigor that the people who buy grain from you use to the farm. And we teach the farms how to look and manage and put together their positions correctly so they know what their risk is. That's the first step, right? They said the first thing, if you ever get lost, the first thing to do is figure out where you are. And that is this position. As Mike said, it is an absolute must when you're a commercial trader to know your position every day. And we think it's an absolute must as a farm. And that's what you want to take off into that spring planting season. Have that done when you have some time, because then you can make those quick decisions.
So, Mark, when you're chatting with clients, with producers, what do you see with those that do know position versus maybe those that are a little bit more uncertain of where they are at this time of year? And how does that create more stress or risk?
So from the lender side of things, when I hear Mike and Jeff talk about knowing their positions, I view that as knowing your cost and understanding your true cost structure. And when are those costs going to need to be paid? And to me, risk or stress kind of enters the situation when I don't truly understand my cost and when they need to be paid. So then things get delayed. And I think today's fertilizer environment is a good example of that. That historically, the best time to buy fertilizer is when the crop is in the field. The old crop has been sold and delivered, and there's not much money left in the checking account. That's generally the best time to go and engage those merchandisers to lock in that product. it's a very stressful time to do that because now I need to either dip into my operating line more than I might be comfortable doing. But again, understanding that cost and making decisions confidently and comfortably, and then backing those costs up with marketing decisions that support those costs. So it's kind of spreading out the marketing decisions on a systematic basis, along with knowing your real hard costs, those rent payments, those equipment payments, and then what's coming up for next year and how long am I going to have to be into my operating line to cover those costs. So when I think of position, I think of understanding those costs.
So a little bit of a topic change here, but moving into the third principle, separate futures and basis forever. Mike and Jeff, I know you're very firm on this one. Let's dive into that one a little bit more. Why is this such a key foundational principle from both of your perspectives?
When we started this business, our mission in life was to level the playing field for the producer. And we feel if you look at sort of the pie of value that transacts in grain between the producer side and the buy side, too much of it slips away from the producer to the buy side because of the reality of not being taught the merchandising skills that your buyers have. And your buyers look at absolutely everything through the lens of basis. There's a lot of misnomers out there about, we already touched upon the futures piece, but 89.5% of your buyers do not care about what's going on in the flat price. They are incentivized, they think through, and their local P&Ls are all determined by basis. So when you can be in those conversations with your buyer and talking only about basis, what is your basis? You shouldn't be asking, what are you paying for soybeans today or corn today or wheat today? What is your basis? You're talking their language. They know that, and you will be treated differently forevermore. And that's sort of a very core intangible in terms of your ongoing relationship and discussions, and just the mere fact that they know that you're talking the same language will have you treated differently forever. And that alone over the course of any given year will be meaningful cents per bushel by just having that discipline.
Yeah, when you look at, as a farmer, and I look at them, if you look at the people we deal with as farmers, right, they're all hedgers, right? They all are hedging grain, and that's how they survive, right? They know that over time, if they try to take and effectively guess on the flat price, that they'll lose. So the people we sell to as farms in the hedgeable grains, and I know not everybody here has in the core, not every grain is hedgeable or every product we make is hedgeable, but the principles apply. They're hedgers. So we teach farmers to think like an elevator. Most farms run elevators today, right? We've changed the nature of farming. We own semi-trucks, we own grain legs, we own bins, we own elevators. And so how do we think more like that elevator manager and manage our risk and what we do? And we don't have to hedge off all the risk. That an elevator will hedge off all the risk. We can contain risk as a farmer as long as we are appropriate for our farm, and every farm is different. And then we go to work on these basis things, but you got to separate the two. And we often see and you often hear, hey, futures rallied, but my elevator lowered the basis equally as much, and I didn't get anywhere. We see a lot of that today in today's, say, corn market. We've had a nice rally, and basis in a lot of parts of the country has just dropped off. We're just moving too much corn. So when we start to really think like an elevator, they're moving in basis, right? We're managing the risk on futures as a farm. We started the conversation there, and then we move over and separate that basis, and that is, as Mike says, that's the language that your buyers speak, and it changes the nature of the conversation, and it adds cents per bushel. There are no silver bullets to becoming a better merchandiser for the farm. It's a whole series. We call it stacking dimes from the world of welding, right? It's penny or dimes on top of each other, doing a lot of little things right. The road to high yields, not some one super magic fertilizer, right? It's doing a whole bunch of things right. And this is very much the same. And our business, Mike, is we just teach these skills on the future side, how to manage the risk, understand the risk, how to be in the right psychological state to do a good job. And on the merchandising side, there are dozens of little things that can be done to add 2 cents here and 3 cents there. And it adds up to significant amount of value for today's producer. And Mike and I have been the first company to open up and say, that's what we're going to do. We're going to teach those same skills to the farm community.
So moving from futures and basis, some more fun grain marketing terminology, which I used to teach commodity marketing at college to my students. And honestly, we just had to define terms for half the semester because it is such a different language. And then once you know that language, you are talking the same terms that merchandisers are. And it really does change things when you get all of those definitions down. So the next one is carry. What is a true cost of carry, and understanding what it means to store grain longer? This is something that maybe gets talked about sometimes more at harvest, but during planting, when capital is already deployed, why is it so critical to know what the true cost of carry is? Let's start with Jeff and Mike, and then I do really want to circle back to Mark and get his perspective as a lender.
What we try to do is we're teaching growers, right? The futures, there's lots of ways to hold futures risk that don't cost a lot. But if you're going to hold futures risk by keeping grain in the bin, it is very expensive. Obviously, interest rates have risen higher over the last few years, and that makes that cost. And we teach in class right out of the blocks. The big thing is interest is even if you're self-financed, you don't have an operating loan, there's an opportunity cost of money. And we teach farmers that is at least a U.S. Treasury. So oftentimes people go, I don't farm with the bank, so I don't have an interest bill. Well, no, there's always an interest charge. There's always shrink in a bin. We just work through the variable cost. And we know as we get to be better merchants that we can move grain. If there's not enough carry or enough to pay the cost of storage, total cost of storage in the market, we can move the grain on a basis contract. Basis has to appreciate enough when you run an elevator business to more than pay the cost of carry. And we get into those details about its interest, its shrink. There's some variable cost in there. Those are all costs that are clicking on every day that we have grain in storage. And the price of the grain outright has also risen a bit. It's relatively expensive to keep a bushel of soybeans. And so you've got to have a lot of basis appreciation to make that. But that keeps us from, in that winning in the detail thing that we talk about, that keeps us from holding grain when the market says, no, it's time to bring that grain to market. And the market is unwilling to pay you to store that grain, which a little kind of nicely leads into our last segment. So
when we're talking carry markets as measured through the lens of a merchant, it's the sum of the board carry and CME futures, and the basis is positive in the deferred bids that you're seeing from your buyer. And certainly there can be the siren song of that, especially in and around harvest to into the spring. But the key thing here is to, back what Jeff said, to know what your cost is to actually get it there and ask yourself, does that net out to hold grain? And there's many other instances during the course of the year too where that pops up. But a really big one is sort of those first 90 days of harvest.
Are you thinking in the same ways as Jeff and Mike are, or do you have other perspectives or additional perspectives, I should say, about how producers should think about the cost of carry relative to their liquidity, relative to their borrowing costs?
My view of the cost to carry is less dollars and cents and more stress and conversation. I take a lot of pride in being very close with a lot of the farms I work with from a relationship standpoint. And it's been my experience that the cost to carry is more than just interest on unpriced grain. It is stress. It is physical stress. It's financial stress. It's relationship stress. It's explaining to my business partner or my spouse why we have to borrow money to make a bin payment or a loan payment or further dip into our operating line to pay for new crop when we don't have last year's old crop paid off. It is a stressful situation that beyond the dollars and cents, that if there's not a good plan put forward early on in the marketing cycle, that carrying grain creates other stresses on the farm that are not always measurable by the dollars and cents of storing that crop, whether it was the right decision or the wrong decision, because you don't ever know that until it's over. So again, I think understanding your cost and executing a plan that works within those costs and then proactively revisiting that plan can hopefully head off some of those physical, financial, and relationship stresses that happen late in the marketing cycle. And I think that when you have that plan, it can actually help you better communicate to your lender, to your business partners, and to your spouse. Why is this a good decision to hang on to this grain?
I really like that perspective of it's a yes and situation. Yes, we need to look at the dollars and cents and truly understand from that cost perspective the true cost of carry. And we have to understand that there is intangibles related to it as well in terms of intangible costs of that stress of not having that marketing plan in place and just holding out for that extra few cents that sometimes will come and sometimes doesn't. So last piece of the framework, we're on number 5 here. Now we're taking carry and we're adding another kind of technical term, the inverted market. So before we get into this foundational, Jeff and Mike, I want you to do your best quick definition of inverted markets and what they are from a structural perspective, but then also follow up with how producers should interpret carry versus inverted markets and what that means for things like timing and storage.
So an inverse is defined by the exact opposite of what we just described in the carry, where the combination of futures and basis in the deferreds are less than the current moment. And in a situation like that, you're sort of dancing with the devil and holding grain through something like this. Taken through the lens of our commercial lives, thou shalt sell your grain, or at a very minimum, get off of basis. Because when you are carrying grain through an inverse, I will steal a phrase from Jeff that death, taxes, and a collapse of the inverse are all inevitabilities of life. So when you find yourself in market structures where this tends to often happen sort of spring and summer in a lot of places, maybe not so much in the Northwest Corn Belt this year and last year, but it will raise its head. And when you see bids in the here and now that are higher than the deferreds, you should be very strongly thinking about getting rid of most, if not all of your inventory, period, full stop.
Jeff, follow up?
No, I think it's just, we're bringing that mindset. We see farms carry grain through inverses, and it's very hard to make that work. It's a little bit about probability. And when you think about if the market is worth more today for your grain than it is tomorrow, you're kind of sliding, you're going down that slide. Not only that, you also have the cost of the storage, right? You can see how these things that we've talked about during this pod are all linked together. And so, yeah, we try to get people to say, okay, yeah, it's time to move that grain, at least on basis contracts, out and think like an elevator. If you think of an elevator, let's say a country elevator has a nickel margin and the market's in a 5-cent inverse for a month. If you don't get that grain sold quickly and on a train, truck, barge and delivered, you'll eat through your entire margin in a blink. And then top on that, you have the cost of the carrying and the shrink and things that will happen when you handle grain. You're actually losing money on every bushel. So really bringing that merchandising mindset to the farm starts to squeeze out what ends up being a lot of money that should end up in the hands of farmers. And the only reason it isn't today is because they've never been taught how to win in these details and make these type of decisions. And that's where we are. And we just know after working with so many farms that there is a lot of money slipping, what we call slipping to the wrong side of the sheet. And in our minds, the entities that take the risk, the most risk, should have the most reward. And that money needs to stay with the farm. And even I look at my own farming operation, and the way we think of this is my farming operation is responsible to manage risk through harvest. And then my elevator business picks up the risk at that point. If it weren't for hedging, rolling hedges, understanding basis, we're not profitable in corn in the last 2 years. But because we have been able to do that, I farm in the East, we've had more volatility in basis than in futures. So there's just a ton of information that the farms need to know, I think, to be competitive and survive in a tight margin environment. And this is one that education is very low cost as far as you think about the things we invest in as a farmer every year, and they have extremely high return. And those are just the kind of investments in tight margin situations that we're looking for on the farm. For my farm, for your farm, people we work with, we're looking for those quick wins, low investment, high return things in education, and even beyond just merchandising skills. There are other things. I think education is one of those places we should be focusing to tighten up our farming operations these days.
So Jeff and Mike have been really focused in on thinking like a merchandiser, thinking like an elevator. Mark, let's talk thinking like a financial officer. Just to bring some of these concepts home, how would you say loan structure should influence cash flow strategy when it comes to things like grain marketing?
Yeah, I'll circle back very briefly on the inverted markets. I always think of the movie Top Gun when they're inverted with the MiG jet, and everyone, when they get back to the base, everyone's surprised and doesn't believe them that they were there. And the reason that they don't believe it is because you're not supposed to be there. And when you're there, you need to take action fast. And as that rolls into how we handle some of that as financial officers with our clients, is I need to understand what their marketing schedule is, their delivery schedule matching loan payments to cash flow, and then making sure that the farm is following through and executing on those plans so they can make those payments and have adequate working capital to do things like buy fertilizer when the crop is in the field and old crop is sold, and make sure that the next year's cost is going to be manageable. So I just think, again, it's the relationship, and at times being frank with them about what's possible and what's not possible within our credit guidelines, and then matching up our payment structure compared to what they're able to deliver on.
Mark, you didn't even know you were doing this, but you have so set me up for a great tie-in to wrap this up. So I love the Top Gun Maverick movie like a lot. I don't know. It's like my happy movie, and I'm not even really into, like, that's not my normal genre. But one of my favorite parts of that movie is when Tom Cruise yells at Goose's son that don't think, just do. And in an inverted market, that's kind of what you have to do. Like at that point, it's not about thinking, you got to make some action. And I overthink everything. And sometimes when you are in these particular grain marketing situations, you do need to take action. And there are behavioral things that sometimes prevent us from doing that. And that's where the good planning ahead of time comes into play. Because if you have it written out ahead of time that if these things happen, you know your position, you know where you're at, you're going to take action, then you can take the thinking, the behavioral traps out of it and just execute. So anyways, we didn't plan this ahead of time, but Mark really made me think of that quote. So as we're wrapping up here, I am just going to walk through the 5 foundational best practices so we can review those 5, starting with 1, hyper-efficient future markets, 2, know your position, 3, separate futures and basis forever, 4, know the true cost of carry, 5, carry versus inverted markets. So to wrap this up, if we zoom out a bit, we're here now in planting season specifically. We've talked just now about some behavioral traps that show up most often. Jeff and Mike, what do you think of as the behavioral traps that people should really be thinking about right now here as we are working through this planting season?
I think we touched upon it, and certainly the last month or so has shown that risk is sort of a 24/7, 365 reality. And don't lose sight of marketing decisions and risk management decisions with all due respect of the insane amount of work that's required in the next couple months for folks to get the crop in the ground. End of the day, we still got to grow a crop, right? But don't lose sight of the risk management piece when you're in the belly of the beast like this. And if you can't do it, have other folks in your operation keeping an eye on this thing. In 4, 5, 6 weeks, a lot can happen. And just make sure your eyes wide open and being ready for it, no matter how busy or preoccupied you are.
Yeah, I would say that when we set up to put this pod together, we said, okay, let's come out with something actionable out of this pod and to mentally get us into a better spot. Separate your farming operation from your elevator business and how you think about it. And then that early big bucket one was we're going to negotiate basis first, and then we're going to talk about futures second and separate those two. Now we have, if you spent the last 40 minutes with us on the pod, here's a couple of good actionable items to take home and practice. Do them in small quantities. You can do them down to a truckload of grain and learn how and get these merchandising tools, get familiar with them and how they work, and add to that box and add to your lifetime education.
Mark, how would you say producers should engage their financial officer in this conversation?
Yeah, I've said it a couple times throughout the pod. I think number one, understanding your cost, your detailed break evens to the smallest denomination that you can calculate per bushel, per acre, and then aggregating it up to the whole farm cost of production. And then taking it further. So you first need to understand where you stand. And then second, to engage your financial officer. The one great thing about Compeer is we do a lot of benchmarking for our clients within the grain markets. So we have data of farms and we can kind of plot where they sit from an operating ratio standpoint, from an equipment cost standpoint, from a land cost standpoint, total break evens. I think knowing where you sit relative to the industry is a very valuable tool that if I'm a high cost producer, I better have a really good offset to overcome that high break even. I better have a lot of working capital to absorb a short-term loss. I better have a good paying off-farm job that can help make loan payments. I better have another stream of income through the farm, whether it's livestock or contract feeding income or custom work. So there needs to be an understanding of what are my costs and how do those costs compare to the marketplace, because you need to know exactly where you stand. And then if I'm out of market from a cost perspective, how do I reorganize my farm to make myself more competitive, to make sales that are profitable or at least a break even?
Really excellent points there. I was going to end with a round robin of what's your last thoughts, but I feel like perhaps Jeff, Mike, Mark, you just gave your final thoughts, but last call on any ending, closing commentary for our listeners.
I'll just throw a quick one out there. So know thyself and know your tendencies. A lot of times when we engage producers for the first time, they tend to say, well, we tend to always do this, or dad likes to do this. And certainly there was something about that got you to where you are today. So we're not here to judge too much, but just know that a typical tendency or a year-to-year practice that follows the same pattern when it comes to your merchandising plan takes your eye off the ball of the market opportunities and the market structures that are out there. So look at every day like almost like you're playing Texas Hold'em, or every week you're getting a new card, and with that new information. So know maybe where some of those tendencies lie and learn merchandising skills and break away from some of those and take advantage of what there's in the market, because you are leaving money on the table by doing something a certain way every single year.
The only thing I would add to that, Mike, would be for producers to communicate their plan. If they are going to take the time to put a plan together, that they circle back with their vested parties, their merchandisers, their lenders, and most importantly, their business partners and their spouses. It's a proven fact that plans are best followed through when they're communicated.
Yeah, I'm going to take this just a little bit different. As a person who's going to head out to the field, and I'm going to say we've got a huge amount of work ahead of us as farms. And when you look at the grain side, a lot of you are going to pull grain out of bins post-planting. It's all about this safety thing. We can talk a lot about merchandising and banking and stuff, but we know farming's a dangerous occupation. And if you're going to go into a bin, you know the rules, right? You don't go in not tethered off. You don't go in without somebody. When we're out planting, I mean, it buckled in the tractors now when we're going down the road. We seem to have so many more road accidents, not in your fault. There's just a lot of little things, and nobody fills your boots better than you in getting home. And for the listeners who are out here, because I think this is going to be happening. I mean, you want to see harvest, right? Whether you're moving grain or trying to get this crop in the ground, you got to just take that minute to buckle that seatbelt or find that extra person, right? And make sure we get the crops out of the bins from last year and that we get this crop in the ground with all of us getting home.
That is a great place to end, because I was going to talk about having a safe and great planting season as well. My phrase on that is always that we talk a lot about sustainability in agriculture, and we talk about it from an environmental perspective and from a economic perspective. But the most sustainable farm is a farm that continues tomorrow because you are safe and you've come home at night and you can go out and do it the next day. So I hope everyone has a very safe planting season, whether you're in the midst of it right now or you're finished or wherever you are in terms of your process. With that, I am Megan Roberts, agricultural economist at Compeer Financial, and I was joined today by Jeff Kazin and Mike Rolson from Agris Academy and Mark Cook, financial officer at Compeer Financial out of the Wade Park office. Thanks for listening. Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit Compeer.com. That's COMPEER.com. Until next time.